Welcome back to Retirement News Online. The idea of tax deferral has long been the hallmark of investing in retirement accounts like IRAs and 401ks. The question now is it always a good idea? My guest is attorney and a financial advisor in Dublin, Ohio, Greg DuPont. Greg, thanks for joining us. And let's again revisit this notion that tax deferral in a retirement account, like a 401k, isn't always the best idea.
Yeah, Scott, I have this conversation with clients frequently where they are in their late 50s and they see that retirement deadline in front of them, and they're trying to figure out how they can catch up and make up for lost time. And often their first thought is to put more money into tax deferral, when in reality, if they don't put that money in tax deferral, but rather use after-tax dollars, they can be able to accumulate the money they need at much less risk than they would had they used a tax deferral vehicle.
So Greg, when you say much less risk, explain that.
Yeah, so for example, let's say that you're a person that's 55 years old, you want to retire in 10 years, and you've got $500,000 in your 401k right now, and you don't quite think that's enough. So let's say you decide that you want to have $40,000 from your savings when you retire. And if you want to take that $40,000 out of your savings at a safe rate that you would not outlive your money, well, studies have shown that that rate's about 2.8%. So if you had $15,000 a year that you wanted to save and you wanted to generate that kind of income from what you've accumulated, you'd have to get a rate of return somewhere near 11% on those dollars to be able to do that. But let's flip the script a little bit. Let's look at it from a different perspective. Let's say you took that $500,000 and you paid the taxes on it right now and put it over into a Roth IRA, and you contributed that same $15,000 a year for the next 10 years. Well, to be able to get that same $40,000 a year you're looking at in after-tax dollars in that environment, you only have to get a rate of return somewhere under 4%. So that's why I say tax deferral can make you take more risk than you need to take.
So finally, these defined contribution plans were actually developed when tax rates were much higher, right?
It was a different time back then. Back when the 401k started gaining traction, there were multiple tax brackets and higher overall tax rates than there are now under the Tax Cut and Job Act, let alone what they were prior to that and what would be happening if the Tax Cut and Job Act expires in 2025 as it's projected to.
That's Greg DuPont in Dublin, Ohio. This is Retirement News Online.